Hello friends, welcome to our live lecture series on financial management. I am once again here to continue our discussion on to the very important and pertinent topic of Treasury Management and Control, Part 3. So, we have already discussed in Part 1 and Part 2 of Treasury Management and Control what exactly it is all about. What do we mean by the Treasury Management? What are the key components of Treasury Management and Control? And at the very outset I told you basically there are two parts of this particular topic of Treasury Management and Control. One which deals with the planning aspect, where we go for planning the cash requirement, or you can say where we actually go for finding out the cash requirement. And in that part we actually go for preparing the cash budget, which we are actually discussing right now. We have been discussing it from the very outset. I told you how to prepare cash budget with the help of different methods, and we had discussed certain numericals with the help of receipts and disbursement method. So in today's lecture I'll actually be completing the planning part of this particular topic, that is Treasury Management and Control, the planning aspect, and we'll be starting with the controlling aspect of this particular topic, wherein I'll tell you about the different types of floats, what are the challenges, key challenges which we come across when we are going for this particular management and control of treasury. So continuing our discussion with the topic of cash budget, today we'll be having another numerical to understand the very basic concept of preparing cash budget. I'll be telling you how to prepare the cash budget. So let's have a look at another numerical on this particular cash budget. You have to prepare a cash budget for Juhi Limited on the basis of following information for the 6 months commencing from April 2016. The company is telling you that the cost and prices remain unchanged and firm maintains a minimum cash balance of rupees 4 lakh, for which bank overdraft may be levied if required, which means whenever the firm will run short of the minimum balance of rupees 4 lakh, what is the plan, what is the alternative that you have to actually approach to your banker for the bank OD facility. So we'll actually be resorting to the bank OD wherever the cash balance is less than rupees 4 lakh. Cash sales, which is given here in the question, is 25% of the total sales, and the balance 75% will be the credit sale. As far as the planning of collection from debtor is concerned, the question tells us that 60% of credit sales are collected in the month following the sales, and remaining 30%, balance 30% and 10% in the 2 following months thereafter. The question also reports that no bad debts are anticipated, and the sales forecasts are given for effectively 10 months. From January to October the sales forecast is given, and the question tells you that gross profit margin is 20%, which means that cost of goods sold is 80%. Quarterly interest payable is rupees 30,000, rent payable rupees 8,000 per month. And further, the question reports that there would be a capital expenditure which is expected in the month of September is rupees 1,20,000. So this capital expenditure will belong to only 1 month, that is the month of September, where the company has incurred an amount of rupees 1,20,000 on account of capital expenditure. So in this particular additional information, there are two important informations where we have to pay little attention. The first is the capital expenditure, and the second is the quarterly interest which we are paying. So remember, we have to understand that quarterly means 4 times in a year. So effectively in a calendar year, as I have been telling you, that the effective period for payment will be in the month of March, June, September and December. So according to the span of our preparation of cash budget, we'll be deciding in which month we have to show the interest. We'll actually look into that, and we'll be showing that particular amount. Anticipated purchase and wages for the year are given this. Purchase and wages from April to September, the amount of purchase is given and amount of wages is given in terms of rupee. And there is no condition for lag in payment of creditors or wages. So accordingly we'll be we'll actually make an assumption that whatever amount is being paid, that is going to be paid in the same month. So with this assumption, and with the help of additional information, we have to actually solve this particular question. My dear students, whenever we come across this kind of question, it is always advisable that start with your working note. In working note, the first and foremost duty of ours should be that we should prepare the collection. We should actually calculate the collection from debtors, because that is something which we cannot do into the question itself. We need to go to working note. The reason is this particular question is not giving you the simplified collection from debtors. as we have been getting in the previous questions, that collection in the first month and in subsequent month. Here the question is giving you a series of collection policy, that they are telling you that 60% is received in the next month, 30% thereafter, and remaining 10% thereafter. So we have to be very meticulous, and we have to be very particular about computing this particular amount of collection from debtors. So let's start with the the collection from debtors. First we'll be going into the working note, we'll do the calculation of collection from debtors, and in that way our task will be easy. While preparing the cash budget, we'll take the total amount of collection from debtors from this particular computation chart, and we'll be showing it in the question, into the solution. So before solving this question, let's go to our working note, and let's see how to calculate collection from debtors. So see, the cash sale is given 25%, so we have written 1,50,000 for the month of April. I have written it 1.50 rupees in lakh. All the values are in lakh rupees it is given, or rupee lakh it is given. Cash sales for the first month, that is April, is 1.50, and the credit sale is 4.50. As per the information given in the question. Now the same computation we have to do for all months from April to May, June, July, August and September, and we have recorded the cash and credit sales. Say for instance, in the month of July it is 9 lakh for credit sales and 3 lakh for cash sale. For the month of September, again it is 6 lakh rupees for credit sale and 2 lakh rupees for cash sale. So this is what we have done. After writing the cash and credit sale, let's go for writing the collection policy, the amount which is to be collected from debtors, 60% of preceding month. So whatever amount is due, remember we have to understand that this collection is to be received from the credit sale only. So 60% of this particular amount is supposed to be received from preceding year, 30% of the next month, and 10% of the subsequent month, that is of the preceding month. So let's start with the month of say April. Remember, for the month of April we have to go to the corresponding sales of March, cause from March we'll be getting whatever credit sale is there in case of for the month of March. That amount actually will be taking as the total sales of that particular month. We'll take the credit sale of that particular month and we'll be writing 60% of that particular amount, which comes here to be 7.20, that is 7,20,000 rupees. As far as May is concerned, for May the corresponding sale will be of April. If we calculate the sale of April, in the month of April the credit sale was 4.50 lakhs, 4,50,000 rupees. So we'll have to calculate the 60% of it, and that will become 2,70,000 rupees, which we have shown under the first collection policy, that is 60% of preceding month. So preceding month's credit sale is 4,50,000. 4,50,000 amount is given. Of that, 60% comes to be 2,70,000. So I'll be writing 2,70,000 in the column of in the month of May for the corresponding value of 60% of preceding month. Now once we are taking the first amount, that is 4.5 lakh, it is advisable that you take this amount and do the posting for all months. So this 4,50,000 rupees I am going to receive in 3 installments. The first installment is of 60%, which I am receiving in the month of May. When we'll go to the month of June, what we'll do, we'll get 30% of this particular amount. So we'll be computing 30% of 4,50,000, which comes to be 1,35,000 rupees. And in the month of June, if you look at the table, in front of 30% collection from debtors, we have written 1,35,000 rupees. So after writing 2,70,000 in the month of May, we have written in the month of June under the head of 30%, 1,35,000. And remaining 10%, which becomes 45,000 rupees, we have written here in the month of July. If you look at the month of July, the column of July, it is written 0.45, it is 45,000 rupees, and that value actually corresponds to 10% of net of preceding month. So remember, once you are taking 4,50,000 rupees, you have posted this amount into all subsequent months, say May, June and July. The same process we have to follow for other months also. Say for instance, if we take the month of May, we have to start with 6 lakh rupees, 60% of it is 3,60,000 rupees. In the month of June it is written 3,60,000. 30% of it is 1,80,000 rupees, it is written in the month of July, and in the month of August again 10%, that is 60,000 rupees, it is written. In this way we have to actually take up one amount. See what I am willing to suggest. I am suggesting here you take one amount of credit sale, the first month, say April, and try to post all the amounts in subsequent month, so that no balance is actually left. Once you will follow this process, you will find that for every month we have three sets of collections. One is 60%, the other is 30%, and remaining is 10%. So all these columns must have certain values. Now once you will post all these values, you will come to know that a point will come where there is a point which is missing. There are certain columns which are having no values, or you can say missing values. So for that you have to go to the corresponding value, you have to go to the corresponding sales of that particular month. Say for instance, when you will go for posting all the values, you will find in the month of April, May and June that certain values are missing. Why it is missing? Because you started from the month of April, so the posting is done for the you can say subsequent periods. It is not done for the previous periods. So you have to understand, once I am in the month of April and I have to post in the month of say for the 60%, I have to go to the corresponding sales of which month? March, because the value of March is going to be received in the month of April. So 60% will come from the March. Now what about 30%? 30% will come from the month of February. So whatever the credit sale of February would be, we have to take 30% of that. We have to take credit sale of February, and 30% of that will come here. Now the same will be the case of say 10% will have to go to the corresponding credit sale of January. So my dear students, you have to understand that once you are doing this kind of computation, you might be thinking that I have to prepare a cash budget from the month of April to September. What is the point of giving sales value of 10 months? This is the reason. Because you will be needing that particular value for calculating the collection from debtors. So you have to understand that whatever the collection policy is, accordingly you have to prepare a calculation table into your working notes, so that you can easily put all the values into your collection chart, chart, where you get all the collections of different months from under different denominations, and then ultimately you have to aggregate them to arrive at net amount of collection from debtors. Now in the month of April, you have to understand whatever the opening balance is given, that you are supposed to receive in that particular month as per the collection policy, as we have been doing previously. So once you follow this particular practice, you can easily calculate the collection from debtors. So in this very question, what I am willing to suggest, or what I am willing to explain to you, is that how to calculate collection from debtors when the collection is very much scattered. When the collection policy is very comprehensive, it is giving you three denominations, that you are collecting 60% of that amount in the subsequent month, 30% in the next month, and again 10% into the next month. So this is what I wanted to tell, that why we are supposed to go to working note for preparing collection from debtors. So this process, I personally feel that you should not do all this calculation into your cash budget statement only. It's better that we go to the working note, we prepare the collection from debtors chart, and then easily we'll be getting the total or net amount of collection from debtors. And that is what is here. Once you aggregate all the amounts, you get collection from debtors for the month of April 11,10,000, for the month of May it is 7,30,000, for the month of June it is 6,15,000, and so on and so forth. So in this way the collection from debtors is computed. Once it is computed, 25% or 30% of your job is done, because there is no point worrying about whatever the amount, what are the different collections, and we are always under pressure that some amount should not be left. So to ensure that there is no missing value into your collection chart, it's better that we go to working note and prepare our collection from debtors. Once it is calculated, it is being shown by the arrow that these are the values which are actually your collection from debtors. Once it is calculated, you can very easily prepare your cash budget. Let's see the way we have to prepare our cash budget. So as per the past practice, we'll be starting with the opening balance. Opening balance of cash is given in the question, 4 lakh rupees for the month of April. I'm just explaining you for the month of April, so that you can understand that in subsequent month also we'll be following the same process. So opening balance is given rupees 4 lakh. Under inflows, we have to write the cash sales and collection from debtors. So I'll be writing the cash sale for every month, like 1,50,000 for the month of April, for the month of May it is 2 lakh rupees, for June it is again 2 lakh rupees, and so on and so forth. Once the collection from debtors comes, once the cash sales is recorded, the next point is collection from debtors, and it is quite easy for us now. We can very well take this particular net amount of collection from debtors from our working notes, which we have just dealt with, and we have to post this collection from debtors into different months. For the month of April it is 11,10,000, for the month of May it is 7,30,000, and so on and so forth. Once it is computed, what we have to do, we have to aggregate the total inflow, which means opening balance plus inflows, that is cash sales and collection from debtors. Once we calculate it for the month of April, the total inflow becomes 16,60,000. And the same is for the month of May, 18,22,000. And we have to aggregate, do this kind of aggregation for all subsequent months from April to September. This is what we have done here. Once it is done, we have to go for showing the cash outflows. Under cash outflow, as I told you from the very question, that for wages and material, there is no payment term mentioned in the question. So what we'll do, we'll make an assumption that this particular payment has to be done, on actual basis, which means in the same month, the amount is to be paid, because there is no other information. So unless otherwise mentioned, we'll assume that this amount has to be paid in the same month. So material is 6,40,000 for the month of April. For the month of May, again it is the same, 6,40,000. For the month of June, it is 9,60,000. July, 8 lakh. August, 6,40,000, and September, 9,60,000. The same will be the treatment of wages. We'll be showing it as outflow. All the amount of wages for different months or respective months will be writing into that particular month as a cash outflow. Now the next item into the cash outflow category is interest on debentures. My dear students, I told you at the very outset when we were discussing about the question that it is actually a quarterly payment. So into that quarter, we have to understand 4 times in a year, in the month of March, June, September and December. And fortunately, into our span, we are getting this payment twice. One in the month of June, the other in the month of September. So in the month of April and May, we will not show this any cash outflow on account of this. In the month of June, we will be showing 30,000 rupees, which we have written here, 0.30. For the month of July and August, again there is no cash outflow, and in the month of September, we will be writing 30,000 rupees. As far as capital expenditure is concerned, question reports that we have only one capital expenditure, that too in the month of September, that is 1,20,000 rupees. The same is posted here. And rent, for the rent payment, you have to pay every month 8,000 rupees of rent. So the same amount is written for every month, starting from April to September. And once all these items of cash outflows are recorded, next job is to aggregate this particular items, in order to arrive at total outflow. And once we aggregate, the total outflow for the month of April becomes 7,68,000, 7.68. For the month of May, it becomes 8,08,000. For the month of June, it becomes 11,98,000, and so on and so forth. So once it is computed, since we have both the values now, cash inflow and cash outflow, it is quite easy for us to find out the closing cash balance, that what is my closing cash balance. We'll once again be writing opening balance of cash, total inflows, and we'll be deducting total outflows out of it to arrive at closing balance of cash. Now if you look at this particular question, the only condition in the question was that your minimum cash balance required is rupees 4 lakh. Fortunately, into this particular question, or by it is only a matter of coincidence that there is no month in which we are running short of rupees 4 lakh. The opening cash balance in all months are more than 4 lakh rupees. In the month of April, it is 4 lakh rupees. In the month of May, June, July and August and September, it is much ahead of rupees 4 lakh, because in the month of May it is 8,92,000, June 10,14,000. In this question, my dear students, at times the mistake which you commit is for the month of April. In the month of April, there is no cash balance given. Opening cash balance is not given in the question. So students are thinking at times that the question is asking us to maintain a minimum cash balance for the subsequent month. No, you are incorrect here, you are wrong here. You have to understand that 4 lakh rupees of monthly balance is to be maintained across the period. So in case question is silent about the minimum cash balance at the opening, we'll make an assumption that this 4 lakh rupees of minimum balance has to be maintained from the very outset. So at the beginning, if no other balance is given, we have to understand that 4 lakh rupees are to be there. Suppose if in this very question, in place of not giving this value of rupees 4 lakh, the question could have given you 2 lakh rupees as opening balance. So what is your first and foremost duty? That the moment you start preparing cash budget, after 2 lakh rupees, you have to ensure that there is a balance of 4 lakh rupees. You'll have to go for taking a bank OD. You have to avail your bank overdraft facility. You'll have to take a loan of further 2 lakh rupees to ensure that minimum balance is always rupees 4 lakh. This is what we have to understand. We have to ensure whenever the question stipulates that there is a condition of minimum cash balance. This is what we have to keep in our mind. So once this cash budget is prepared, we have understood in all months we have maintained successfully the minimum balance of 4 lakh rupees. So there is no point bothering about that. Closing cash balance comes 8,92,000 rupees for the month of April. For the month of May, 10,14,000 and so on and so forth. So in this way, my dear students, we have understood how to prepare the cash budget. we have actually discussed with the help of receipts and disbursement method, or it is also known as receipts and payment method, and how to calculate, how to prepare a cash budget. So in different problems, with the help of different examples, I tried to make you understand the way we prepare cash budget. What are the points which we are supposed to keep in our mind? Remember, at times for preparing cash budget, we provide you, the income statement, or you can say the income statement or the financial statement of the company, and we ask you to prepare cash budget. That is also a way to calculate. So the type of information, the way of giving information may be different, but remember that you have to prepare your cash budget in this way only. In due course of my discussion today, I'll be telling you about the other two methods of preparing this particular cash budget as well. But remember, this receipt and disbursement method is one of the most popular and commonly used method. That is why we have taken so many numericals into this. As far as other two methods are concerned, they are actually linked with the pro forma income statement and balance sheet that we have already discussed in the topic of financial forecasting, where I told you how to prepare pro forma income statement and balance sheet. So I hope you must have recalled that particular pro forma income statement and balance sheet, which we did in our lecture of financial forecasting. Once the cash budget is done, we have to understand into this treasury management and control. At times, cash reports are prepared. And my students are asking me that, sir, what are the circumstances where we prepare cash report? What is the difference between the cash report and cash budget? So there are a number of questions which actually come into your mind the moment we talk about the cash report. And at times my students are asking me that, sir, we already had a cash book. So what is the point of preparing cash budget? Remember, my dear students, cash book is entirely different with that of cash budget. Cash budget, you must have understood what we are doing into it. It is a comprehensive statement which is giving you the comprehensive information about the different receipts and payments, and it is actually telling you about not only the composition but also the direction of your cash inflow. That is why there is no substitute of cash budget, and still it is very much popular among the financial fraternity, where we are making use of this particular cash budget. So let's understand what exactly the cash reports are. Cash reports are basically prepared in certain situations where the cash inflows and outflows do not fluctuate much. Remember, we have to keep this thing in mind that we will only be preparing cash report when we are assured about this, that the fluctuation in cash inflow and cash outflow is not very much or very high, and the collection and payment patterns are stable. So this is the prerequisite for preparing a cash report. If your organization is of that type where there is no such fluctuation which is happening, if your cash collections, cash inflows and outflows are stable in nature, there is not much fluctuation into your collection policy, then obviously you should prepare cash report in place of preparing cash budget. Now, cash report can be of different types. Basically, the cash report help in comparing the actual figures with the forecasted figures and in controlling the deviations that exist. You can compare the actual figure with that of forecasted figures, and suppose if there is some variance, there is some deviation that you can compare, you can exercise control onto that, you can find the reasons for that, and then you can make changes into your particular policy. But remember, if the fluctuation in the cash position are very high, then the reports are prepared on a weekly basis, and at times it is on daily basis, just like cash budget. So cash report can also be prepared along with the cash budget, provided you are willing to prepare whether you are willing to prepare a cash report or you are willing to prepare a cash budget. So we have to understand, if the fluctuation is very high, in that case you have to understand that your cash monthly, or you can say annual cash report, will not help. So the important categories of cash reports are basically daily cash report. Basically, the daily cash report provides information about the daily cash position. It is telling you that what was the opening balance at the beginning of the day, what were the transactions which has taken place across the day, and what is the closing balance at the end of the day. It indicates opening and closing cash balances, payments made to creditors, repayment of loans, and other cash flows. At times we prepare daily treasury report also. Daily treasury report and daily cash report, they are slightly different with each other. A daily cash report does not indicate the position of accounts receivables. It doesn't tell you about the position of account payables and marketable securities. Whereas daily treasury report will not only provide you the opening, closing and transactions, opening balance, closing balance and transactions, but it will also provide you the position of accounts receivable, account payables and marketable securities. The daily treasury report fulfills the requirement of presenting a comprehensive statement about certain things, and they are the opening balance, the closing balance, the net balance of marketable securities, accounts receivable and account payable. That is why daily treasury report is a popular kind of report which is being opted by or prepared by the fund managers, because they feel like having the complete information about the opening and closing balances of receivables and payables as well, along with the payment pattern. As far as the monthly cash reports are concerned, so apart from daily treasury report, daily cash report, we may prepare monthly cash report. The monthly cash report actually shows the cash receipts and payments over that particular entire month. So for the entire month, it is actually giving you a complete idea about the cash position of the company. So cash report, in a way you can say, if your organization is small and the number of transactions are not very much, in that case we may suggest to go for preparing cash report. But remember that if you want comprehensive information, then in that case you will resort to treasury report, daily treasury report or monthly treasury report, or you can say quarterly treasury report. So apart from cash budget, we can have a set of cash report also, which can help us. Other methods of preparation of cash budgets, here I need to discuss that what are the other methods of preparation of cash budget apart from receipts and disbursement method. There is the second method, which is known as adjusted net income method. It is just like taking the value from profit and loss account, that is the income statement, and converting and eliminating all non-cash items from it to arrive at the what you can say is the cash profit. It is just like finding out the cash profit, but apart from the finding out the cash profit, what is the difference? We have to prepare pro forma income statement for every interim period. Say for 4 months if you are preparing, for all 4 months you have to prepare pro forma income statement, and there we go for making a projection. So in this method, basically you get the exact amount of cash profit, but you don't get the composition of it. So that is why we go for preparing cash budget via receipts and disbursement method. So in this method, I told you what we do. Apart from this, we have another method called pro forma balance sheet method. In that method, what we do, just like I told you in financial forecasting, how do we prepare the pro forma balance sheet? In pro forma balance sheet, what we were doing, we were actually trying to find out the value of EFR, that is external fund requirement. Here what we do, apart from cash, we post all the items. We make projection for all the items for the interim period, and the only amount which is missing there is the cash balance, and it is found as balancing figure. After posting all the amounts, whatever is balancing figure, that becomes your cash value. So in this way, we can find out the cash requirement via pro forma balance sheet as a balancing figure. But remember, the limitation remains the same in these two methods, that is, they are giving you the exact value, or you can say the absolute value of that requirement of cash, but they are not giving you the composition of this particular cash requirement. So in this way, my dear students, we have understood, we have discussed the planning aspect of treasury management and control. In the next lecture of mine, I'll let you know how to go for controlling aspect of treasury management and control. I hope you must have understood and enjoyed my today's lecture. Thank you so much.